Okay, there you go. That should work now. I think I fixed it. Let's see. Perfect. All right, cool. Well, so big things happening in the markets. So to give you guys kind of a summary, uh, let's go to our Chrome tab. So, um, Federal Reserve. The Federal Reserve meeting is coming up. So there's 8 meetings per year, I'm guessing, I think, where they have each one they might make a cut, a rate cut, right? So the 16th, 17th is coming up. This is next week. So this is gonna be Tuesday, Wednesday. So I'm gonna let's ask Grok. Um, let's ask Grok. Um, when is the upcoming Fed meeting and what is the expectation when it could be announced? So basically, the markets are betting that there's going to be a rate cut. So as you can see, Fed decision in September, there's well, this has actually changed since I last viewed this morning. But um, we'll get to what I'm trading, but I gotta go through the situation. But 91%, 25 basis point cut chance, 9% of greater than 25 basis points. So they might even go and like cut 50. And then 3% on Fed maintains rate. So this was actually at 4% earlier today. So everything went. It looks like it just got more likely that it's going to be a 25 cut. So 2 p.m. ET on September 17th would be when they make the cut. And then there's more cut expectations, but I'm not worried about that yet. So with these cuts, I mean, some people say that everything like this is always priced in, but I don't really trust that. So what I've been looking at is, I mean, I think gold and silver are obviously gonna run if we get a rate cut. And I mean, this is gold and silver have just been of year in the next year. Simpler you can back up. Well, okay, we'll get to that. Let me get to what I wanted to go through first. But gold and silver are good because if there's a rate cut, then inflation is going to go higher because there will be more capital getting injected, and so you can expect everything to just inflate. And so silver and gold, I think, are good ways to protect against that. And in my opinion, Bitcoin as well. Um, yeah, but the problem that I have is like I hold gold and silver, but I have a really hard time buying at these levels just because it's ridiculous how much they've run. It's just absolutely crazy. Like there's even a chart of gold price adjusted for inflation. Mm, so yeah. So gold, no, this one is a little, this one's 2022. I want the new one. Mm, is this adjusted for inflation? Okay, there you go. So This is a day ago. Perfect. So basically, gold always goes up because it's just because of the inflation. More dollars get printed, so gold starts costing more. And obviously it has cycles, like for example, in 2008, after um, after the huge '08 crash, uh, gold had a massive run, um, and then it kind of dipped down and it was going low, and then ran up again during COVID, went flat for a bit, and then started running up again in 2022. Um, but the what's interesting is that when you adjust it for the inflation, right, that's kind of more almost a more important thing to look at because it means like how much are people valuing gold regardless of the inflation? Are you trying to hedge inflation or do you want to be exposed to CPI growth? Like make money if prices go up or just not be exposed to the risk of prices? Um, no, yeah. Yeah, I mean, I think it's an inflation hedge, right? Because like I don't know. I have a problem like I don't think cash is really good position right now. Like if you have a lot of cash, that stuff is burning. I mean, like if we go what's the 2.9%, and this is the official data I'm guessing. So, yeah, but you're losing 3%, if it's in a let's say it's in a CD, you're getting like what 3.5%. So maybe you're breaking even after the taxes. Um, but anyways. So, but my thing is like this is just I don't understand like it's really hard to buy gold here just because of how much it's peaked. And I think people always say that gold is like a predictor of of whenever there will be like a big stock market correction. Is that before that gold starts running up? And right now gold has been running up, but stocks continue to go higher. Mm. So yeah, I don't know. That's um now looking at Bitcoin. So I I sold a bunch of Bitcoin, forget when. These are some really old drawings. I don't know what they mean. Uh, wait, how do you get rid of all the drawings? Yeah, okay. Anyway, um, like Bitcoin went all the way to 124, 500, and then it was back at 109. And I was like, okay, at 109, this is something to buy just because like I feel like it could go a lot higher. Hmm. Like yeah. And I mean this was basically I think the right call to buy here. Unfortunately, I didn't buy that much. I only went in for a little because I wanted to go in over a few days, but it immediately started running up, so I didn't really get the chance to keep buying. And now I don't really want to buy at this price level anymore. Hmm. But I think it can still go higher. Um, because if like I know the rates get cut, just the amount of people who can take out loans cheaper and then go buy Bitcoin with it. Like it's pretty crazy. But think about it, like Michael Saylor can go and just take out loans like 0.5% cheaper and keep loading up Bitcoin. Um, like I just don't really see how that can not run in that case. Um, so I feel like into December we're gonna make all-time highs, and then after that we're gonna have like a really bad correction all of next year. Um, but anyway, so that's Bitcoin, silver, and gold. Um, Now this is kind of the play I'm more interested right now, which is small caps. So IWM, this is the small cap ETF. Um, Basically, it has underperformed um, the S&P this year. S&P 500 has just been doing better than small caps, like significantly better. Um, if we go to like I guess 11.54% better. Um, but small caps did really well like from April where they hit this low and now it's just been a crazy run up. Um, but I don't know. I see a lot of tweets on Twitter that there's going to be rotation into small caps because the point is that small caps are more like to them the mm, I should try arbitraging forward rate contracts against prediction markets. Um, Maybe. I mean, if you can write the software and run it and it like for 30 days and it works, then like let me know because we can definitely work a deal out. Um, 3% is low for inflation. Yeah, no. So well, there's another post I saw that um, God, what was it? Uh, Inflation CPI data imputation. Oh, 3% chance of no rate cut. Mm, yeah, I mean, I don't know. Everybody's saying Powell's gonna cut, so there's that. Um, very nice. But anyways, so yeah, basically, well, you can't freaking, but the graph tells you when you this is the share of different sell imputation for commodities and services prices survey. So the CPI, the people releasing the CPI, the Consumer Price Index, which I think is used to measure inflation, they're just not getting as much good data. So they've just started like imputating it, which like I'm guessing that just means looking at like the numbers you have and trying to like model the other numbers. But I mean, it could also just be outright fraud, right? Like I imagine a scenario where Trump's calling them and being like, "Hey man, you need to get inflation down," and like firing anyone whenever a bad inflation report comes out. Like you could have some shady stuff start to happen. Um, so yeah, that's the thing that I don't trust I don't trust the CPI anymore. I don't trust the official inflation uh inflation statistics. Um yeah, I mean look at this. It just doesn't make any sense. Like in this digital age where we have like Amazon, Google, and like I don't know, like how can you not be able to calculate inflation? Like What is going on here? This is just so weird. Um, but then the other thing that's happening is just the jobs reports are very bad. Um, they're being revised down. I think the last one was revised down by 900,000. Um, so why are these all July jobs report? Employment situation summary. Let's just look at this. Is there's no chart? This is just the freaking August 2025. Unemployment rate seasonally adjusted. So unemployment's climbing, right? Like it's, I mean, surely someone has a unemployment chart. Yeah. So this was '08, this was COVID, and now it's here at 4.3%. So like it's been, I mean, it hasn't climbed that much, but it does keep going up. And the thing that like I don't understand is why it keeps getting revised. US created 911,000 fewer jobs. Isn't that crazy? So they just told like the markets, "Oh, we created this many jobs and like everything's good. Keep pumping the stocks, guys." Um, and then it just turns out like, nope, there's actually much fewer jobs. And then the other thing I wanted to show you guys, uh, if I can find it, uh, hold on. But delinquencies are on the rise. So orange, this or brown is student loans. So student loans, this kind of makes sense because they were pretty high but stable. And then during COVID, they literally passed laws that meant you don't have to pay your student debt off for now. Um, so then nobody was in trouble because you didn't have to pay. And now you have to pay again, and it's going up again. And this is like a very rapid turn up. Now, mortgages and home equity appear fine. I don't really see a problem there. But honestly, that just might be the split. Like, the baby boomers or maybe the millennials who bought a house in like 2008, um, or at some point have a stable job, like they're doing fine. But then like people who haven't had that much time to be in the economy, don't have any assets, aren't really benefiting from the stock market running up, right? Because if you've been in the job market for like 10 years even, you have a hopefully you have a nice cash pile and you're sitting in the S&P 500 and you're getting 15% every year. Um, or depending still some amount. But people without any assets, they're just getting killed. And you can just see that with this credit card loan delinquencies. I mean, we're approaching 2008 levels of credit card loan delinquencies, which is just crazy because you don't like it doesn't seem because this happened at like 2010. So the crisis was like definitely there by 2010 and the rate was that high. While right here there's still no crisis. Like nobody is like AI keeps booming. Everything is just up up up. Um the S&P 500 really weeble. The S&P 500 is just absolutely like flying. Like there's no sign of any correction or anything at all. Like it's just going. Um, and then auto loans, you can also see that. And by the way, with auto loans, what just happened is Tricolor. Um, where's Tricolor? Tricolor collapsed. So Tricolor was basically um, subprime auto lender. Isn't that crazy? Like we all remember this, right? Like we've all watched The Big Short, like right? Subprime mortgages. Now it's subprime autos, specializing in loans to low income and often undocumented Hispanic borrowers. Um, well, they basically filed for bankruptcy and collapsed on September 10th, 2025. They're getting liquidated. And there's a fraud case by the U.S. Justice Department, and then they were also basically packaging their loans into bonds that were AAA rated as recently as 2025. That ended up just being complete shit bonds that like nobody's gonna pay off their auto loan. Um, and yeah, and so even like JP Morgan, where does it say that? Uh, JP Morgan and Fifth Third alone could lose over 400 million combined. So, I mean, and if this is just the first thing that happens, because like I don't know. I mean, is this a single event? Like, is this a single company that messed up, or is it indicative of something else in the market? Um, but yeah, you can see auto loans also delinquency is rising. So, mm, there's that. Okay, next picture I had for you guys. Oh, yeah, this tweet. Absolute banger tweet. But basically, with delinquencies increasing, like you can see in '08, credit card limits started dropping. So, um, basically, they just started going lower. And that makes sense because if there's more delinquencies, then people are like, okay, the banks are like, well, people can't pay off their credit cards, so we're not going to give them as much money to loan out. That kind of makes sense, right? Well, instead of doing that, we just keep going higher. Like credit card limits keep rising, um, credit card balance keeps rising, and credit card delinquencies keep rising. So they just keep chasing. They're like, okay, people aren't paying off their credit cards. We don't care. We're gonna give out more um, credit card limits and just see what happens. So that's just crazy to me. Um, and then yeah, it just I don't know. Um, and then here's another picture I think is important. Um, but basically, so blue is job openings and red is S&P 500. So you can see it makes sense. It kind of tracks each other, right? Whereas there's like less job openings, S&P 500 drops, and then more job openings as the market rallies. Well, and then you have the unemployment level here. Now, I don't know why this graph is cut off, but basically you see unemployment goes up in the recession, and then as this is, as the market's doing well, job openings are opening up, unemployment goes down, and they kind of track each other, uh, right? And so, for example, here in COVID, unemployment level was going down, market was going up, everything was great. Then COVID happened, and unemployment level spiked, and everything dropped. Um, but then here we see job openings have been dropping since this kind of peak, and the S&P 500 dropped a little bit in like what is this? 2022, late 2022, and job openings just continue going down while the S&P 500 just runs. And the unemployment level is going up, ticking up like bit by bit, and it just doesn't make any sense. Now, one explanation that is, you know, possibly valid is that like AI is taking over. So maybe there's the reason there's less job openings is because people are being replaced by AI. You no longer have to pay somebody to do the job. You just use an AI to do it. Um, and so the companies can continue to profit and make their product while hiring less people. But I don't know, man. Like I've used a lot of AI models and I don't see it that way. Like I don't think AI is just actively replacing all these jobs and all these people. Um, and I don't believe that that can be like the sole reason for this happening. So very, very weird. Um, okay. And then here's another thing. So go on Google Trends, look up um, sell my house fast. We want, why is it 62? That's so weird. Shouldn't there be much more? Then look at this. Give bar back. Hmm, Look at this. Bankruptcy lawyer. Everybody's just searching for bankruptcy lawyer all of a sudden. Isn't that crazy? Like, who's going bankrupt? So, yeah, just not good. And I don't think this can end well. Like, we've just been pumping, pumping, pumping. And, like, I'm seeing a huge correction coming. But it's hard for me to say because they do print a lot of dollars. And all those dollars have to end up somewhere. And looks like they're ending up in the stock market. Mm. Now, I do want to take a look at the stocks I mentioned. So small caps. So the reason I'm looking at small caps is because they've underperformed the big caps, S&P, in the bull run, and they are the companies most affected by interest rates because they're more likely to have debt, and this will allow them to borrow more and possibly refinance their debt at lower rates. Um, Now, I was really interested in this IWM, and the reason I was interested is that um, August August 22nd. So August 22nd was the Jackson Hole meeting where Jerome basically said that they're going to implied that most likely there's going to be a rate cut in September, and this thing jumped like 4% in a day. And since then, it's basically been kind of flat. So that's why I feel like this thing would definitely run if there's a rate cut. And then the other option is TNA. So TNA is just 3x leveraged IWM. I think you don't want to hold it long term because you start getting basically it loses a little bit. So it's a little worse than 3x, you lose a little bit. But short term is just 3x, right? And you can see this right here, right? August 22nd, where Powell talks about the potential rate cuts, and um, we go up 12%. So, and I mean, event analysis with daily, weekly returns around the rate cuts. Yeah, so I mean, like this just doesn't make any sense. Like Powell didn't say he's gonna cut rates. He kind of implied it. Um, yeah, no, yeah, I agree. Do an event analysis with the daily, weekly returns around rate cuts. Um, yeah, and I mean, but here's the thing. So we look at this August 22nd, what happened? Uh, Fed maintains rate just dropped. So was that at what? I hate this chart. Is there a better? But August 22nd wasn't when the job data was released, right? When were the job data released? Yeah, August 1st and September 5th. August 1st and September 5th. Um, so August 1st, let's see. Why is this chart so... Kalshi needs to fix their charts. This is so hard to use. Is there a way to like export it? August 1st. Yeah, that makes sense. So it did jump. It did jump on August 1st. And then September 5th. September 5th. Where is that? Didn't really jump on September 5th. Or, no, I guess it did. I guess this didn't jump, but we even got a hint that it might be a more than 25 basis point, 'cause it might be 50. So that's why, so the black is maintains rate and it went down and it crossed over with the 25 basis point cut. Um, so yeah, I guess I mean the job data, yes, it also I mean it's clear from these two that it correlates. But this Jackson Hole speech, there was no job data. It was just him speaking. Um, and honestly, uh, I don't think he said much. I will Jackson. Let me turn the desktop audio on so you guys can hear this.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework as captured in the revised Statement on Longer Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged a make-up strategy to ensure that inflation expectations would remain well anchored, even with monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored.
Basically, I don't think he said anything. Like, this was kind of just like a nothing was said meeting. But the market, I mean, this increase from like 55% to like 75%, right? 55% to 75%. And just on that increase, this thing ran, TNA ran 14%, 12%, 12%. And now we're at 92% with, I guess, an 8% chance of an even greater cut and a 3% chance of maintaining. And I think if this happens, like, it would just make sense to me that TNA, IWM, the underlying, right? And then TNA would run again. So that's my take. And I feel like right now is kind of the last chance to buy in. And I mean the thing I'm worried about a little bit is like like this is basically hitting resistance from 2024. So that's, I don't know. But I just feel like rate cuts have to make it run. Um, but then the other thing is, so I'm not too bullish on just real estate overall. Uh, but I looked at this, and this is VNQ, real estate ETF. So one, this hasn't crossed this is higher than it was this year, but it hasn't crossed its peak of 2024. And when there's a rate cut, real estate is really affected by it. So I feel like it could really run if there was a rate cut. And I feel like it wouldn't even hit resistance until here. So I feel like it could run, quite a bit there. Like, I don't know if we draw this, like from here, could definitely see it running 3%. Um, and then RHP, this one, I mean, it tracks it. This is an individual company. It tracks VNQ pretty closely. Not totally, but pretty similar. And then the thing is just that RHP was just purchased by Marjorie Taylor Greene. So she just purchased RHP, um, which is interesting. Um, but yeah, so those are kind of my bets. I don't really know. I wish I had like a better bet, like a company maybe that could really benefit from rate cuts. Um, Actually, maybe I should ask Grok that. Let us ask Grok that. Find an opportunity to buy. Is Grok down? Grok is so down. I guess we'll ask Gemini to do this for us here. Um, Grok servers are down. But yeah, so I mean, overall, I just see things are gonna keep running till December. Um, but I don't see, like, I feel like after that we might be in trouble. Um, and I feel like AI is the other thing. So NBIS, I mean, this has been on a crazy run, and I've been saying I bought a bunch in April, have been selling off as it spikes. And I completely exited when it hit 92. So I exited at 92. It hit even up to 100. Um, but the thing is, Like this is all based on a contract with Microsoft. This last huge run, which it was a huge contract with Microsoft, but like still, you know? And and the problem is that like how many more of these contracts are you gonna get? And for that contract, are you sure that it's gonna be 100% filled, right? Because all the news stations are reporting like, oh, the total worth of the contract. Well, that contract is over a set period of years, and it's only if every clause in the contract gets, bought, then it will be that amount. But even more crazy is Oracle. Look at this. Super similar. Very weird how it's just like so similar to NBIS, where it just rocketed off of a contract. I guess this happened on the 9th or the 10th. When did the NBIS happen? Uh, oops, it's the wrong. Yeah, same day almost, like maybe one day apart. And it's just crazy. Like, what? Like, how is this happening? Um, but here's what I want to show you about the Oracle contract. So basically, Oracle OpenAI signs $300 billion cloud deal. Um, Shares soared 43%. It's a risky gamble for both companies. OpenAI is a money-losing startup that disclosed in June it was generating roughly 10 billion in annual revenue, less than one-fifth of the 60 billion it will have to pay on average every year. So OpenAI doesn't have the $300 billion, and they won't even be profitable until 2030. So in order to even pay out this contract to Oracle, they're gonna have to finance that $300 billion somewhere. Um, and then Oracle doesn't have the chips. I think this is less of a problem. Like if you get the money, I feel like you can get the chips. Um, but I mean the bigger problem is like, yeah, where is OpenAI getting their 300 billion? Um, so yeah, I mean it doesn't make it's starting to I mean I hate to say it because I know like there is a lot of innovation going on, but like what are these jumps? Like is this the top? Very similar here on Google. Just absolute jump. I don't know. I don't even know what happened, but it was just like a huge, huge jump. NBIS, huge jump. Oracle, huge jump. I don't know. Um, it's definitely making me nervous. I'll say that. Um, what else did he mention here? CRWV, right? CRWV. V. I guess CoreWeave. Well, no, I mean there's still like it's more timid compared to the others, but there's still this jump. Um, so something happened on December 9th and 10th. Something like something big happened. Um, and I don't think it was just those two contracts. I think it had to have been something, something weird. Is Grok back? Oh, it didn't even, it had to ask me to start the research. Let's get another Gemini. Um, Oracle, NBIS, Google. So, yeah, I mean, let's see what it says. All right, I'll let it load and I'll be right back, guys. Fueled by mixed major corporate announced and broadly optimistic. Was dramatically soared. It doesn't want to answer if this is the top or not. Yeah. Hmm. Man, yeah, I don't know what's going on. This is all very very complicated. But I'm holding Weeble. I'm holding Weeble. I'm holding VNQ, a little RHP, lots of gold and silver, um, and yeah, I mean, I feel like TNA is the play. Honestly, TNA and VNQ. I think there's two plays here. Um, VNQ is my worry with VNQ is that it's modest, right? And it's just gonna be like a lot. You have to put in a lot of capital and get like what 3%? What was this? Yeah, barely 3%. TNA obviously, it's a 3x levered. So if IWM moves 5%, TNA goes 15%. So that's better, right? Is there VNQ lever? Let me see. VNQ lever. Yes. Oh, bro, it's giving me this bullshit. Okay, let's see. Pending catalyst. Following real estate investment trust rights. This is important, I think. This is something to screenshot for sure. So, I mean, there it is. Gemini calling top here. Gemini calling the top. I do want to recreate this chat though, because I feel like I might have biased it. So, what is this? Okay, see if it says. DRN. So it's saying DRN might be something. This might actually be good. I mean, like this has a lot of space to run. Right, like if we are gonna see a run and it's hit support, I mean, although there is some resistance here. Although I don't know how that works for 3x leverage ETFs. Maybe that's all different. Who knows? But again, like in terms of performance, these real estates, they didn't peak in March like TNA did, right? Well, no, I guess not TNA, but IWM, sorry. And that is the peak, and it wasn't like that in the previous 2024. Right, so it's already up to its 2024 height. It's not up to its March height, it's up to its 2024 height. Whereas VNQ is only up to its height here. So, but I think VNQ could run um, TNA. I think very possible. DRN, I don't know. Interesting. So, hmm, it's so funny. Gemini just like I want to recreate it again. See if it gives me. So it definitely gets biased, right? Same with not in a bubble. Interesting. No, it's just I don't know. I mean, this seems like we're fine, right? Let's see what Wall Street Bet's saying. Yeah. I don't know. Yeah, this is not really useful. Neither is this. Because they only did by year. I kind of wanted to see like more. Yeah, I mean, I guess one last thing we can check is AI bubble. Let me just remove all these. Remove, remove, remove. AI bubble. Hmm. AI. Hmm. Interesting. Anyway, so I'll leave it at that. I mean, yeah, I don't know. We'll see. We'll see what happens. Good luck to Jerome Powell, and yeah.